That is complete opposite of what the infinite banking concept is. But yet somehow this is what they're calling the infinite banking D-myth. The details always matter, always.
This doesn't sound like their insider knows how to design the policy.
All we've talked about is the products. The process is how you build wealth using this. The product just makes it work better because of that compounding interest. So this is what we teach. This is not just a product. This is a process that we're doing here. Welcome everybody. Welcome to another wealth webinar, but today is going to be like no other wealth webinar we've ever done because we are literally going to do something that I think will be so impactful, not just for you folks, but for every single person out there who was ever presented or told about the infinite banking concept. Because let's face it, right? People all the time talk about the infinite banking concept, and usually it's a very divided response. You either got people that hate it and say it's a scam, or you got people that are like, it's life-changing, it has changed my life, everybody should be doing this. Literally, there's very little middle ground, okay? Well, I started by playing the Dave Ramsey video that I played, and I want to point out one very important thing. I don't care whether it's Dave Ramsey or the ones that we're going to be bringing on today, which, just so everybody knows, do any of you or have any of you ever heard of The Money Guy Show? There's two guys that put on a show on YouTube. They're very popular. They got about 441,000 subscribers. So a very popular show. And these guys are great. Like, I've seen their stuff before. I like their stuff, but they crossed the line a little bit. Now, not in a bad way. And today, what Craig and I are going to do is we're literally going to walk through their video. You are all going to get to see their video. But what we're going to do in this video is we're going to stop them where they're wrong. Not going to beat them up like I do Dave Ramsey, because these are good guys. Dave is just an arrogant, you know what. But these guys are actually good guys, trying to do good things for their viewers and for their clients and trying to really educate their clients. But the problem is there is a very fine line where they're educating, but they're educating on misinformation. And I'm going to use that word because that became very popular during the pandemic, misinformation. So today what we're going to do is we're going to unravel the misinformation. We're going to show you why these two awesome guys and their show, and I'm going to give them props, the Money Guy Show, why what they're trying to tell you here is completely off base. They missed the boat completely. Here's why. So many people, especially people, like Dave Ramsey, Susie Orman, or these two gentlemen, they always want to talk about a product. It just seems like it's product specific. It's product centric. So when someone says to any one of you, the infinite banking concept, is the first thing you think about a whole life policy? Because if that's what the first thing you think about is, you're also misguided. The first thing you should think about when you hear the word infinite banking concept is a process. That's what it is. It's a process, not a product. I've taught the infinite banking concept, not just using specially designed whole life, but also I've shown it using 401ks and loans from your 401k. I've shown using the infinite banking concept from bank accounts. Matter of fact, I did a video just for people outside of North America because they don't have whole life. I showed them how to do the infinite banking concept using just a bank account. And we've also shown it using home equity lines of credit or other places. You see, the infinite banking concept is not discriminatory to just whole life insurance. However, as told by and taught by the late R. Nelson Nash in his book, Becoming Your Own Banker, one thing is absolutely mathematically certain. Whole life, specifically, specially designed whole life, absolutely is the most efficient vehicle to use with the infinite banking concept. But make no two ways about it. It is not the only way to do the infinite banking concept. Are we clear about that? So the only reason R. Nelson Nash and us over here at BYOB and the Money Multiplier, the only reason we use whole life is because mathematically, it just works best. It absolutely works the best. And we're going to get into why. But here's the problem. And then I'll roll this video. Most people, when they're talking about the infinite banking concept, hone in or hyper-focus on a product, the whole life. But most people focus on a normal, off-the-shelf whole life. Like just you went to your brother-in-law and your brother-in-law said, oh, yeah, the infinite banking concept. Yeah, I can definitely help you with that. meaning I can sell you a whole life policy. Now, how many of you in the chat want to be sold a whole life policy today? I hope every single one of you says no. But how many of you want to learn a process that will completely change your financial future and also your kids' financial futures and their kids and their kids and their kids? Doesn't that sound like something you want to learn? Well, that's the infinite banking concept. See, nobody wants to buy something. Nobody wants to be shoved, a whole life down their throat and say, oh, this is the infinite banking concept. You need a whole life. So then explain to me why Dave Ramsey and these two gentlemen from this show, why all they want to talk about is a whole life policy. And to make that even worse, they talk about pretty much only a standard off-the-shelf whole life. That's the baseline for what we're going to get into. But here's my effort. And I'm gonna put an ask out there in case some of you know these two gentlemen. My ask is that these two gentlemen watch this video and learn from it. And even if they don't agree with it, maybe what we can do is a healthy, happy, friendly, productive debate. They can talk about buy term, invest the difference, which listen, I own term insurance. I like term insurance. We use term riders on most of the policies that we design and engineer. So we're fans of term insurance. We're just not fans that buy term, invest the difference is the only way and the best way for everybody. Because there is no one thing, no one product that fits the bill for every single person. True or true? So that's what we're going to talk about. Today, we are literally going to unravel what they said is infinite banking exposed. That's the name of their video, Infinite Banking Exposed. But then they go on and they say insurance companies, let me make note, insurance companies are lying to you. Infinite banking exposed. So in other words, they are saying that the insurance companies are lying to you. The insurance companies, they produce a product. They provide a service, right? They protect you when you are no longer here. That's what you buy insurance for. The insurance companies are not designing and engineering these policies. We are. We're the surgeons, the experts, the specialists that have learned how to take an insurance contract and re-engineer and redesign it within the parameters of what the insurance companies allow. It's not the insurance companies scamming anybody. It's not the insurance companies that need to be exposed. They're just doing what insurance companies do and always have. We are the ones designing and engineering that contract so that it works to provide a more efficient money vehicle for a process called the infinite banking concept. Today, I feel like we have the ability to really, really pull the blinders off a lot of people and show them the path to infinite banking concepts. So with that being said, folks, I am going to introduce each and every single one of you. Craig and I are going to introduce every single one of you to these gentlemen right here. Can you see them? They're handsome little buggers, aren't they? Like, their show is really good. And it's called The Money Guy Show. Now, I'm going to play this video, and we're going to stop and pause this video. Craig's actually going to be in charge of this. Craig is going to stop the video, and we are going to unravel and dissect certain pieces of what they say and bring the truth to you. But see, we're not going to just give you our opinion. That's the one thing I promise you we're not going to do is give you our opinion. We're going to literally factually prove or mathematically prove anything where we disagree with what they say. Fair enough? Craig, is that an accurate way to say it?
That sounds fair to me. And yeah, let's just jump into it. And one thing I wanted to say as well is, as we go through this video, the Money Guy Show, they're doing some comparisons of infinite banking to investments, and they're almost thinking as if infinite banking is an investment. We're going to get into some of the holes that I think they left in terms of the investment concepts, but infinite banking is not an investment. The whole life policy is not an investment. It's simply a place we're running money through before we go do something else with it. And I always like what Nelson Nash talked about is we finance everything we do in life. And so infinite banking concept is really about, I have $1 in my hand, I'm going to buy a car. Do I send that dollar out and I never have the use of it again? And so I just want to make it clear that we're not going down that road of saying infinite banking is an investment tool. However, can you invest with the money that came out of your infinite banking policy? I mean, we do that all the time. The private money club, the money tank. I mean, that's what a lot of those discussions are going to be about. However, let's go ahead and jump into it because there's a lot to dissect here.
There is. All right, folks, buckle in, get ready. We're going to take you on an unbelievable ride and hopefully these two awesome gentlemen will watch this video and learn something new and maybe even do a debate with us. So let's roll.
You keep hearing about this infinite banking. Have you ever want to know what's the scoop? We got you covered.
Brian, I am so excited about this because this gets so much press and we get so many questions asking us about it. Guys, what about infinite banking? Is this what the elite wealthy do? Is this what the top rung of society is doing? Is this the secret financial thing that I need to know about in order to truly be a financial mutant? So in today's show, we want to unpack that.
Well, here's the thing that gets me is insurance is a very necessary part of the wealth building process. What I don't love is somehow in this modern world we live in, you cannot help but turn on social media and people will tell you 401ks are a scam.
Yep.
And it's typically followed by, because where you need to be putting your money is in life insurance, whole life insurance, and even bank on yourself through infinite banking. I'm just glad that we finally have been able to find an insider that would share the details with us so we could do this content. So stick around to watch all the details on infinite banking.
Yeah, that's a great setup, Brian. What we've done is we actually have a listener out there that says, hey, actually, I do this. This is a strategy I perpetrate. And every time you guys talk about this, you're not actually using policies that are designed for this specific purpose. So we asked this friend of the show, hey, why don't you send us some policy design so we can actually do a side-by-side case study to see if this is merited. But before we get into that, for those of you who don't know, for those of you who aren't familiar, infinite banking or bank on yourself is a way in which you use whole life insurance to build up savings and leverage cash values for self-financing. It may be pitched as an alternative to putting your money in a bank or putting your money in the stock market. You instead get to be the bank. So that's the pitch. You no longer need a brick and mortar. You no longer need a financial institution. You yourself can become the bank.
Now, look, I want to play the part of helping you kind of walk everybody through this. And sometimes when I see definitions, it doesn't really tell the full picture, Bo. So how about a visual? Do you have a flow chart or a visual that can help people who maybe are the learners who go beyond the words?
That's exactly right. So here's what you do. You as a policyholder, you're going to pay premiums or send cash into a whole life insurance policy. It's going to be a life insurance policy offered by an insurance company that you're going to pay a premium into every month. Well, with that premium, one of two things is going to happen. Part of it is going to go by a death benefit. If you were to die, a death benefit would be paid out to your beneficiaries. And the other half is going to go to build up cash value inside of the life insurance policy. Well, as that cash value then builds, you as the policyholder can then borrow against it. So if you need to be able to have money to spend, rather than going to the bank and pulling money out of a bank account, you can instead use your life insurance policy as the bank to pull money out of.
Now, I already noticed something that's a little concerning to me, Bo, is that when I talk about life insurance, I'm very familiar with buying term life insurance, which is...
Well, hold on a second. I just want to stop right there. Craig, again, you got the slides. So the first thing I want to point out, as we're very early in this video, is right there, he kind of drew it out, right? He gave you a visual of the infinite banking concept, but you see how front-loaded it was to just be about the policy. Never said anything about specially designed, so I don't know if they understand the policy can be specially designed, and I don't understand if their insider understands how to even build the policy. As a matter of fact, Craig and I, we would basically, I'd put probably $100,000 wager on it that the guy, their insider that designed the policy we'll get into in a second for them, has no idea how to design a policy for the infinite banking concept. And we'll show you how we know that, and we'll show you how we can prove that that person has no idea. But one thing that was just said there, and Craig, back me up on this. They mentioned then you can take loans and leverage against your cash value, but they didn't talk about for what. They literally just said to pay for things in your life or to pay for expenses. You all know this. I think unless this is your first time here, you know that like we never, ever, ever tell people to take loans from their policy to pay for groceries, diapers, rent, or any household expenses, because that isn't what infinite banking is designed for. Infinite banking is designed to take back the banking functions in your life, to take back the banking functions on things like big purchases, cars, or debts that you might have, like lines of credit, credit cards, or to take over your banking functions of how you actually deploy savings into investments like real estate, or heck, I mean, these are stock guys, so into stocks or other investments like that. We never, ever, ever, ever would tell you to take a loan from your policy to pay for any of your household expenses. That's what your bank account's for, folks. So Craig, anything on that before I continue rolling this?
No, I mean, at the beginning, I think we start off with, I think it was, the first guy says, why would you want to do this versus a 401k? And I think it sets the precedence for the whole discussion on the wrong path, because that's not what we're teaching. That's not what we're saying. We're not saying don't invest, but there is a difference between saving and investing. And to your point, we're talking about taking those savings and putting it somewhere else. I don't consider putting money into a 401k as a savings. That's for down the road. That's investing, right? So I think we kind of got set off on the wrong premise to start with. We're not talking about, do you invest or do you save? Well, you should be doing both. We'll get more into this, but how do you use it exactly? We're not going to go buy our groceries with our whole life policy. We're going to finance the things we need and want in life. We're going to do an and, not an or. And when we talk about investments, they continually beat the or drum. You can do this or you can do this. And we're talking about you can do this and you can do this. You can put money into your whole life policy. You can put money into this process. And we have some diagrams we can share as well. But think about a private lending deal. Could you just take money out of your savings account and put it into a private lending deal? Certainly could. Could you leverage your cash value to go do a private lending deal? You certainly could. So you can do both. It's not an either or.
And I think that's a key thing you just said there. And we got to give credit back to Mr. Caleb Gilliams, who wrote the book, The And Asset. If you haven't read that book, folks, please grab his book. It's called The And Asset, which literally dissects exactly what Craig just said about, we're not talking about you're going to put money in a specially designed whole life or you're going to put money in a 401k. It's never an or. You're going to put money in the whole life policy, the specially designed whole life, to then use it to go out and invest. So it's and invest, and buy real estate, and pay off debt, and buy cars, whatever it is you're using it for. It's the and asset. So let's dive in and keep rolling, because you're going to see how this goes completely down the wrong path in just a second, because it becomes hyper-focused on a product that isn't even designed the right way.
And I do want to make a point. They have an expert, right? They've claimed they have an expert that provides them a policy, an insider that provide them a policy. And we're going to dig into that a little bit more, but just know that now they've got their expert, and we're going to take a look at their expert's work.
Is primarily you are buying the insurance. If something happens to you, you get paid, but it doesn't build up cash value, right? Meaning that there's not an element of investing or making the premium level in a permanent way. Mm-hmm. But I also noticed the thing that gets me, this says whole life insurance. Why don't you tell us what variables or factors are needed to really set this up? Because that's already a unique thing to be whole life insurance.
That's right. In order, and this is what we were told, again, by our insurance insider, hey, you got to make sure that you're buying the right type of policy. And so let's talk about the elements that make up this infinite banking policy. The very first thing that you need, what you have to buy, is high dividend paying whole life insurance. Now, you immediately alluded to something, Brian. Immediately, our spidey sense goes off when we hear you have to go buy whole life insurance. Because we know all the time that we...
And let me just correct them just right here, just because I feel it's proper. It isn't high dividend paying whole life. All whole life policies that are issued by a mutually owned life insurance company pay dividends. The dividends are what the dividends are. They're not high. What we're doing is we're designing and engineering a policy for high early cash value. So there's a big difference between high dividend and high cash value. And right there, you start to see they just need a little brushing up on this.
We talk about term insurance versus whole life insurance. There's a very tangible reason why we like term insurance more.
Well, first of all, life insurance, I think, is a period certain need. Like hopefully the goal is that you're saving and investing, you're building up your army of dollar bills. So hopefully at some point you become self-insured because you're financially independent. You don't need to replace your income anymore because your assets will talk for you or protect you and your loved ones. That's not what I'm seeing here, because when we talk about whole life, the premiums are substantially higher. And I know
that this is a very, very important piece right here. So like we've hit a fork in the road, if you will, because now you can clearly see they favor term insurance, and you can clearly see that they don't like whole life, or don't favor whole life would be a way to say, but fact or fiction. So Craig has put together, by watching this video many times, fact or fiction, and I've written them all behind us. So I guess I'm just going to go to all 150, what do we got, 154 people on here, and I want to ask all of you, fact or fiction? Do you want your life to be period certain? Do you want to protect your life just for a period of time and then self-insure after? Like, in other words, do you know when you're going to die? And if you do, and you think you're going to live longer than what your term is, your income replacement term insurance, do you want to self-insure after that? Do you want to make sure that if you die after term's gone, that you're going to have enough assets to pass on to your kids? Or would you prefer that the insurance company just writes a big tax-free check to your family anytime when you die? Like, you can't outlive it. I don't know, fact or fiction. Craig, what do you think?
Well, the word that stood out to me as I watched this video over and over was hopefully. Did anyone catch the hopefully word? Hopefully you have assets built up. Hopefully you have enough to self-insure. Hopefully. And what if that hopefully doesn't come to fruition and you're in age 65, 66, 67? What's our term cost now? How much is our, ability to go out and buy a term, a 20-year term policy? So we'll see it later in the discussion, but they start comparing, what if you had a term policy now, you have higher death benefit while you're waiting for the whole life to grow and catch up. But at the end of that cliff, when the term's done, you're at zero. And hopefully you have enough to self-insure. And I think everyone has to kind of answer this for themselves. Do you want to have any sort of protection, life insurance protection, when you get older?
Yeah, and I think an important thing, Craig, to talk about here is that we do like term insurance. We fully understand there's a massive need for term insurance in almost all of your lives. And all of you will probably agree as well. In your life, you have things that have a term of time. Your mortgage, you probably took out a 30-year mortgage, right? Therefore, your mortgage is a liability for your family if you die before that 30 years. Because if you die and your family or your kids and your spouse are living in the house, and now all of a sudden they got to fend to pay the bills and everything. So like, that's a great thing, because if you had a term policy that protected that mortgage for 30 years or 20 years or whatever your mortgage is for, and you die, the life insurance company pays a check tax-free to your family, and it pays the mortgage off. Now that you could go right down the line. You could say that for business uses, businesses have lots of debt. So you could use term insurance to protect debt in a business. If you plan on exiting a business in a 30-year period or 20-year period, you could do that. Cars, 5-year notes, right? You could protect a car for 5 years. You could protect your income during your peak income years. So let's just say you plan on retiring 20 years from today. Great. Term insurance would be great income protection for 20 years. But just like we mentioned earlier, when we're talking about term and whole life, it's not this or that. It's this and that. Because what are some of the things that you want to make sure happen after that term of time? You want to make sure that your funeral and your burial expenses are fully covered, right? Because term isn't going to take care of that. You want to make sure that your family is going to live a better life when you're gone, no matter when that is. And it has nothing to do with a debt or something that, has a term of time. You just want to make sure that you pass on a legacy to your family. And I could go on and on. I mean, estate planning, estate taxes, we could talk all day long about that, but there's a place for both. And I love this because now, as you're going to see as Craig gets into the designs, when we get there, we're going to bring them together. We're almost always in the designs we do going to have a term rider. Now, it might not be forever. We might have it on there for 7 or 10 years, but we are using term insurance because of what he just started to say. Term insurance is the cheapest life insurance. But that's not the truth either. And I tricked all of you by saying cheapest because that's what everybody wants to hear. Let me tell you what term insurance is. Term insurance is the single most expensive life insurance you will ever buy, solely because the actuaries that work for the insurance companies have mathematically proven through actuarial tables and hundreds of years of data, proven that when you buy a term policy, there is less than a 2% chance that life insurance company's ever going to have to pay out on that policy. So what's more expensive? A whole life that the premiums are higher on today, but you never outlive it, and it will always pay out the stated death benefit, or actually, as we'll show you, more than the stated death benefit in the future, no matter what. Or a term policy, which you are literally gambling. It's just like going to the roulette table. You have less than a 2% chance of that insurance company ever having to pay out on that contract. So even if you paid less for it, there will be probably no benefit ever paid. Therefore, everything you pay cheaper by today's standards in terms of a premium, but most expensive because there's no benefit ever paid. And that's proof. That is factual proof. Look it up, Google it. Term insurance, less than 2% of all term policies ever written pay out. So what's more expensive? Well, I'll let you decide.
Well, and Chris, I really like Rhonda's comment. Rhonda says, term is for if you die early, whole life is for when you die. And I just think that's very well put.
All right, well, let's keep this going. And then again, we're just going to keep interjecting and just trying to course correct them and give them the proper information so that they're not doing videos on misinformation.
We even have some research on that.
Yeah, if you look at how much insurance coverage costs, and this is for a female in excellent health for a $500,000 policy. If you were going to go buy term insurance, it would cost her $188 at the age of 30. That same level of coverage for a 30-year-old would cost $4,000 a year. So $4,000 versus $188. Fast forward to a 50-year-old female in excellent health. If that lady wants...
Sorry, just one very vital piece of information they missed is, and maybe I missed it, Craig, so correct me if I'm wrong. What type of term insurance? Is that a 1-year renewable term where every year it gets more expensive? Is it a 5-year term policy where it's locked for 5 years, then jumps huge? Is it a 10-year term policy, a 20-year, or is it a 30-year? Because those things make a massive difference in the cost of the term policy. Just looking at the numbers, I'm going to take a wild swing at this. A $500,000 term policy for $188 a year, probably a yearly renewable or a 5-year term, but I could be wrong. Craig, did they say anything about the type of term they're buying?
I didn't hear anything about it.
Did anyone hear anything about the type of term? Was like, what was the duration of term we're buying for $188? You see, the details always matter, always. And they're leaving details out. And we also don't know what kind of whole life policy they're buying. This is probably just a standard off-the-shelf whole life, but that's okay. Let's keep going.
Wanted to buy a $500,000 policy, she's going to spend about $644 a month for that term coverage. If instead she wanted that same amount of coverage in whole life insurance, it's going to cost over $9,400 a year. So these are very different when it comes to costs of getting that insurance coverage in place.
But it's called permanent insurance for a reason. This is meaning you're planning on buying this policy and holding this policy until you pass away.
Yep.
Whereas term, as the title kind of alludes, is only for a period certain of time. So I'm a little confused on that, but I'll let you keep us on this journey.
So specifically, this, you want to make sure that you're buying high dividend paying whole life insurance, because you can use other types of permanent insurance, but dividend paying, or also known as participating policies, are the ones that work best. And there's a few reasons why they work best. Number one, the premiums don't go up as with other policies. So you can actually lock in a fixed premium for the life of the loan. The other big way that these policies are sold is that the cash values are guaranteed to go up. If you look at other types of cash value whole life policies, they have a guaranteed rate that says no matter what, we're going to make sure that this goes up. Not all cash value policies work that way. Some of them can actually decrease in cash value. But if you buy a guaranteed whole life policy, you can assure that you're going to have some minimum rate of return that you receive. Now, here's the problem, though.
Actually, a problem did just come up, but I'm going to give these guys the benefit of the doubt, Derek. They did say monthly on those term premiums, didn't they? They did. They said term, the monthly, and then they used annual for the whole life policy. So if we were to just do the math, I could actually roll it back, but I think you remember the numbers. It was like 588 or something, but he said a month. That would be more than what the whole life costs. So I think they just made an error, and that happens in videos sometimes. I'm pretty sure that those term premiums and the whole life premiums were being stated as annual. So I'm going to give them the benefit of the doubt. You're right, Derek. It would have been $7,700 if the term cost $644 a month, but I think that was just a misquote. So I'm giving them a benefit of the doubt on this one, but not in a little bit.
When it comes to buying whole life insurance, there are often a lot of very expensive commissions, very expensive fees that go into this. So Consumer Reports came out and said, hey, when we look at all the different cash value whole life policies out there, the average rate of return, and this is including the dividend payments, but with the guaranteed cash value built in, is only about 1.5% per year. So if you look at the average of all the policies out there issued, the average is 1.5%. Now we're going to talk more in a moment about how we're going to try to use a policy that's custom built to satisfy infinite banking, but right there on the start, even though there's a guarantee at 1.5 or around 1.5 does not get me super excited.
That doesn't.
And I don't know a single life insurance company that we use for the policies we design that only pays a guarantee of 1.5. I don't know, not a single one. The lowest is 2%, but with dividends, they're at like, I think 5.3. And then the highest one we have right now is 3.75% guaranteed. With dividends, they're 5.85. And I'm just going out of memory.
It completely shocked me because whenever I hear the word guarantee, when you're talking about financial products, that's a heavy burden. That's a word, like I know when you're doing securities training, they tell you never, ever, ever use the word guarantee because that's something that, I mean, if you are taking on risk, you that by its sheer nature is not, it's you're getting risk, you're taking a risk to reach a premium in return. There's a risk reward from that. A guarantee has to be at a lower price point, and that's why there's fees, there's lots of other things. I completely get why a guarantee is going to be a much lower rate of return.
So the first thing, we're thinking about the elements that you have to have is you have to have a high dividend paying whole life policy. The second thing that you have to have is a lot of cash. So this is a little bit
false. You do not need to have a lot of cash to do the infinite banking concept, because the minimum to make this work, and we have proved it thousands of times, is 10 times your age if you're between age 20 and 60, which means just add a 0 after your age. That's the minimum monthly. Now, I doubt that would be considered wealthy by any means of judgment in terms of what's wealthy and what's not. Craig, anything on that?
No, but I do want to go back and highlight a point because we've glossed over it a couple of times. They talk about the high fees, the high commissions. And whenever I hear something's high fee or high cost, compared to what? And we can get into some of this later, but a lot of times we hear people talk about, well, we have these index funds or only 1 to 1.5% fee, but these whole life policies, oh boy, these insurance agents like you, Chris, man, you're just raking it in with these huge commissions. And so we're going to address this in a little while, but when you hear about these high fees, what my mind's always thinking about is compared to what. So we'll get into some of these index funds that they talk about and really how do the fees stack up on that versus we'll show kind of how the policy performs over time.
Craig, like what you're talking about with the high fee or the fees with mutual funds, we're not actually going to tell you anything. We're going to just read from the SEC website, which you'll find out that later in this video, these guys mentioned the SEC and this information. So we just did what they said. They said, go to the SEC website. There's all sorts of information. So we did that. And actually, Craig, what the heck? Let's just show it to them right now. Do you have that up real quick? Can we just, they're talking buy term invested difference as Craig's getting this slide ready. And buy term invested difference requires investing money. Now there's all sorts of different investments, right? You can invest in ETFs, you can invest in mutual funds, individual stocks, individual bonds, but they're specifically talking about indexed mutual funds. That's the key word. And that's what Dave always talks about too, indexed mutual funds. So right here, like, let's just do what they say. So we're talking about fees and expenses. So Craig, what'd you do to find this?
So anyone that has a browser, pop it open and type in fees and expenses, SEC. That was my Google query.
SEC is the Securities and Exchange Commission.
Yep. Right here, how fees and expenses affect your investment portfolio. Let's just go check it out. And Chris, to your point, I mean, we're not making this stuff up. Here it is. So let's go ahead and increase this up a little bit. All right. So on the SEC site, they're talking specifically about if you have a portfolio value of $100,000 over 20 years, what's the impact of a point, a quarter point or a half a point or a whole percentage point of an annual fee? And you can see this significant drop between, how that impacts your portfolio over time. I like this second one a little bit better, it's a little easier to see. So I'm gonna scroll down. So in 20 years, the total amount paid for a 1% annual fee is $28,000 of that 100,000 in initial investment.
Wait,
That's
so
a
Craig,
lot.
hold on. Let's just do the cumulative because that's just easy to understand. So over 20 years, if you invested $100,000 at just a 1% annual fee, most advisors charge far more, and most mutual funds, except for like Vanguard and some of the index funds, are more than 1%. So you're telling me that 28% of the amount I invested went to fees?
Well, I'm not telling you that. That's
Oh,
what I'm reading.
yeah, SEC told you that.
Yeah, the SEC told me that. So I'm going to assume that they're telling me the truth here. But that's 28% right there. So when I hear about these high fees, I always want to know compared to what, and this sounds to me like it's pretty high. So we throw that 1% or the 1.5% annual fee around quite a bit, but it's actually very significant over time.
Well, look at that. SEC says over time, even ongoing fees that are small. So super inexpensive Vanguard index funds are small fees. They can have a big impact on your portfolio, like over 20 years, 28%. This is the SEC, folks. Like we're not making this up. Like do the homework. But like, I love that you mentioned, Craig, compared to what? So let me just ask everybody, because listen, sometimes I just think differently than everybody else, and that's okay. But if I was going to give away $28,000, okay, for something, I would want to know, what did I get from that? So here, remember, we're talking about an indexed mutual fund, okay, which really requires no management. It's just index, it's passive. So no financial advisor really needed to buy an index mutual fund. And, the fund is going to charge me a fee. So it just kind of rolls and I give $28,000. So what did I really get? I don't feel like I got a whole lot. I mean, the returns went up, down, up, down, up, down, but over time they went up. And then, not only that, I know that the fund made money. Now, how many of you want to make Vanguard, BlackRock, Fidelity wealthier? Is that something is that your all-inspiring goal in life? To make Vanguard more money, to make BlackRock more money? And I'm just pointing out just some of the big ones that you would know. I don't think it is. But now let's just transition that. Compared to what? Well, let's say, whole life insurance has a fee called cost of insurance. So a whole life, basically, there's a cost of insurance for the life insurance benefit. Okay, then there's a policy service fee, which is between $50 a year and $100 a year, depending on the carrier. And then up front, there's a commission paid to us, which we're going to hit that hard. So let's just defer the commission, because these guys are saying we get paid huge commissions. So I'm going to debunk that, because we design and engineer it so that we actually get paid stupid low commissions. But that's okay, because by us designing the policy for low commissions, you, the client, or all of our clients, get more cash value. But how many of you would rather take the $28,000 in fees, we'll just keep it that dollar for dollar, and have that $28,000 pay for insurance, life insurance, so that when you die, no matter when that is, because we're talking whole life insurance, no matter when that is, a death benefit is paid to your family? Would you feel better about paying for that? Because I would be perfectly fine giving that $28,000 to an insurance company so that I am protected the day I die, which is a guaranteed, because I want to talk about guaranteed. We are guaranteed to die, and we are guaranteed to pay taxes. So, the death benefit, just so you all know, is guaranteed to be paid out when you die. And also the death benefit designed properly is guaranteed to be tax-free. So I'm liking those guarantees. How about you, Craig?
Yeah, I love the guarantees. And I mean, that's one thing that this SEC report doesn't really take into consideration is what's that taxable burden going on to the next generation, or what was the taxable burden that you had during your life on all of this? So I think this number is less, right?
Yeah, Craig, one thing though, these guys are smart guys doing this video, and everybody on here is really smart. So they could say, yeah, but what if I put the money in a Roth? Then it's tax-free. Right, you are. But now you've given up liquidity of that money, because you're not going to have access to the money inside of a Roth like you would inside of a specially designed whole life, which we'll demonstrate. But hey, kudos. I would give it to them that they would be smart enough to kind of pivot and say, yeah, but we're not paying taxes on this because we're investing the difference in a Roth IRA. Okay.
Mm-hmm. Yep. All right.
Anything else with this?
I think that covers this piece for now. We can kind of dig into some of the rates that they talk about, but let's roll the video again.
So folks, and if you guys have questions, folks, just put them up in the Q&A. We're checking the chat as we go, but we're really just trying to, kind of side with these guys and give them the benefit of the doubt that they're not bad guys. They're not trying to deceive or give anyone anything. They just got some bad information here. And that's what we're trying to correct here. So let's go back into it here.
Counterintuitive. In order to be able to execute an infinite banking or a bank on yourself strategy, you have to already be someone who can dump tons of cash into these policies. So right there,
Where the heck are they getting, you need to be able to dump tons of cash in? Craig, I know we just stopped, but like, how many clients do we help set up specially designed whole lives to be used with the process called the infinite banking concept that are by no means dumping in tons of cash or doing huge premiums, but yet still getting massive results? There's a lot, isn't there?
Yeah, I mean, every day we're helping people that have, like you said, 10 times your age or maybe a little bit more. And so, yeah, I think this whole comment about a lot of cash, I'd really like to understand, if we were talking to them, where did this come from?
I would too, but let's keep it rolling, because now they're talking about the elements. So first off, we've already got them on two things. You don't need a lot of cash, and we're not talking about high dividend paying whole life. I still don't know where they got that from, but the insurance companies are lying to you, right? Anyway.
off the bat, that's fairly limiting, right?
Yeah.
Because not everyone has a ton of excess discretionary cash flow that they can throw at this kind of policy. And so the question you may ask is, all right, well, why do I need that? What do I want to be happening with this tons of cash? Well, what you essentially want to have happen is part of the cash you're putting into the policy is going to pay for the premium. The other part, and the premium being what the insurance actually costs, the other part is going to go to building up the cash value. What you want to do by dumping as much cash into this policy as you can is you're buying paid up additions. And what paid up additions are entirely paid for life insurance additions that both increase the death benefit, increase the cash value, and thus increase the dividends that are paid out. So for infinite banking, this paid up addition is primarily used to increase the cash value as much as possible, so the dividends that pay on that cash value are as high as possible. No different than if you had a bank account and you want to put as much money into that bank account as possible so that the interest or the dividends you earn on that is as high as possible.
Now, wait a minute. When I watch the brochure commercials, everybody always says you put all this money in, but here's the benefit over investing. You get access to your money completely tax-free.
Mm-hmm.
How in the world... I mean, because you're making this thing sound like you're just paying for a lot of life insurance.
That's right.
How am I going to get access to my money tax-free, as I've often hear people talk about?
So when we think about the cash value increase and you're dumping this money in, and we look at the average dividend rate, the 10-year average dividend rate on cash value policies is somewhere around 5 to 6%. Some companies a bit lower, some companies a bit higher. But the thing that makes this exciting or gets people excited about is exactly what you said. You actually have the ability to take loans from the policy. So if you need money, if you want to access the capital, you can take a loan from the cash value that is, quote unquote, tax-free, where you can then use that money to go consume goods or to go buy products or go do fill in the blank. You are borrowing money from those copious amounts of cash that you've paid into the policy to build up that cash value.
Now, wait a minute, because I'm already...
No. Now, wait a minute. But when you borrow money from the policy, you're not actually taking your cash value. Your cash value is just collateralizing the loan. Matter of fact, you're taking the insurance company's money. They're loaning you their money from the general account. They're just subtracting it from the death benefit. Therefore, one key piece they miss here, and we'll hit this again later, is your money, your cash value is still in the policy, still compounding at that guaranteed interest rate plus dividends, which they alluded is between 5 and 6%. That's absolutely correct.
Spidey senses are starting to tingle a little bit here, and the fact that leverage is not something that taking on encumbrances don't tie into financial independence, because those two words, independence, encumbrance, those just don't work. How are you going to make this work where I'm taking loans? Because aren't I paying interest rates on this stuff, Bo? I mean, there has to be a catch here.
That's exactly right. So a lot of these loans do indeed have interest rates that you're paying. Now, before we go into the interest rates that you pay, there are two different types of loans you ought to know about. There are what are called direct recognition loans, which means when you pull the money out, you don't earn any money, you don't earn any dividends on the money that you've pulled out. Well, then there are non-direct recognition loans where you do keep earning dividends on all the cash value, even what you take out as loans. So again, I'm trying to think about this in terms of banking.
Let me just hit one key piece, not super important, but direct versus non-direct. We talk about this a lot. We do a ton of videos explaining the difference between the two. His explanation is correct, but they are not a type of loan. They are a type of insurance company. They're how the insurance company itself views the loans. And its direct recognition would be some companies that recognize the loan, and non-direct would be the companies that don't recognize it. So it's not a type of loan. It's not like you can call the insurance company and say, hey, I want one of those non-direct recognition loans. No. The insurance company is a non-direct recognition company. So just little correction.
On direct recognition, if I put money in my savings account and then I go to pull the money out of my savings account, I no longer earn interest on that money that was in there. With non-direct recognition, it's like I can pull the money out, but I'm still getting that. However, you've already alluded to this, these loans do bear interest. Well, if you now have an interest rate you're paying on the loan that's greater than the dividend that you're receiving in the policy, it does not work. It falls apart. So there's another feature, because these insurance companies that think of everything, where they make a...
So I think that's a really important point. He said, what happens when your interest rate is higher than the dividend being paid in the policy? Has that ever happened?
We're not talking about just the dividend either. We're talking about the dividend crediting rate, which includes the guaranteed interest rate plus the dividend. So when an insurance company declares a dividend and puts out their dividend crediting rate, that's a blend of the guaranteed interest rate in the contract. It's contractually guaranteed to never change, and the dividend, which, yes, is between 5 and 6. So let's just assume that the insurance company charges you 6.25, which none of the ones we have that we work with are doing that. But let's just assume that you're earning, let's say 5.5, and the insurance company is charging 6.25. Let's actually round it up and say 6.5. Oh my God, that would be terrible. That would make these guys right? They don't understand math, Craig. They're not thinking about the math, because the insurance company charges you simple interest on the loan. The insurance company is paying you compounding interest. Okay, so your dividends and guaranteed interest rate, that blended dividend crediting rate, is compounding and never changing if it's a non-direct recognition company, which is the only ones we deal with. And if you're doing the infinite banking concept, I'm not saying it's the only one that works, but it certainly beats direct recognition. So you'd have to then, and we will show you this, folks, in a little bit, the math. You'd have to understand the difference between simple interest and compounding interest. And folks, listen, there is a huge difference. So mathematically, we will prove that later in today's recording. But should we continue on? Because I don't want to rain on their parade here, because they're on a roll.
Yeah, and we will touch on the fact that even if they were correct that your interest rate's higher than what you're compounding, can you still make money? And we're going to cover that.
Absolutely, yes.
Available what are called wash loans, where you can go take a loan out of the policy and you can guarantee that the rate you pay in the policy matches the dividend rate so that it doesn't flip upside down. But as you can imagine, if you're trying to get one of these policies that has non-direct recognition loans, and those loans even operate as wash loans, what's likely going to happen is either the costs and fees of the policy are going to be greater, or the rate of return they're willing to give you through the dividend rate is going to be lower. There's going to be a cost somewhere.
I've watched a lot of social media. I've never heard a lot of people talking about direct recognition, non-direct recognition, wash loans.
Awfully complicated.
This stuff, I mean,
it's not complicated at all. And we've done it numerous times, so they're not watching our stuff.
my head's spinning a little bit on this. So because this is not anywhere that I'm seeing on social media, maybe we ought to take a few steps back and at least, why don't you bring this back to what are the benefits they're at least telling me I'm going to get out of this? Because right now the details are making me feel like I'm swimming upstream on this. So at least let's break it back in a little more elementary. Tell me what the brochure says the benefits are.
So let's look at the brochure. Very first thing, we already said this. They tell you, hey, the dividend rate will be 5 to 6% or more each year. And if you look at the 10-year average dividend, so you can think about that kind of like interest rate on your savings account, dividend rate on your cash value, somewhere around 5 to 6%. Returns on the policy are guaranteed. So that's not like investing in the stock market. In the stock market, the market can lose money. It can go down. If you have a cash value, whole life, high dividend paying policy, there's likely going to be some guaranteed rate in there. So your money can't go down in value. So a lot of people like the security around that. So that's another brochure
There's
benefit
got to be a catch to that. I know you're going to cover the catches in a minute, but there's got to be a catch to tell me I can make 5 to 6% guaranteed, because we have it in all caps for a reason. There's got to be something more to it.
Let's keep going with the brochure, though, because the other thing to say is, hey, not only do you build this cash fund, not only do you have this capital that you can use, life insurance also offers protection for your loved ones in case something were to happen to you, and it's there forever. It doesn't go away at some point in time. So not only do you have this bank that you're building where you can get the money out, but your beneficiaries, your loved ones are taken care of if something were to happen to you. And I think this is the biggest benefit that people really dive into this. Your money will be accessible when you need it. Unlike a 401k plan where you have to wait till retirement and you can't access it until you're old and decrepit. So this is what they say.
If anyone's picking up on this, and I know some of you are, like Mark and a bunch of you are commenting, they're still only talking about the product. And the spread they were talking about, or lack of a spread as they were alluding, is the insurance company charges you X and the insurance company pays you Y. And if X is greater than Y, you're upside down. They're not talking about using the cash value to go out and work for you a second time. They're not talking about uninterrupted compounding interest. And then I just want to give them a little thing, like, I don't know what brochure they're talking about, but your money will be accessible when you need it, unlike when you invest in a 401k. Folks, we talk about 401ks all the time. And what do I tell every single person I ever talk to? Put into your 401k up to the match, because the match is kind of like getting free money. But you also have access to 50,000 or 50% of your 401k. So you have liquidity in your 401k. You have to pay it back. There's risks if you lose your job or get let go and you don't pay the loan back. But technically, you can access 50,000. So I don't know what brochure they're seeing, but it's definitely not what we teach.
Well,
healthy dividend rates, guaranteed rate of return, life insurance protection, and you can get to the money when you need it.
We've done this all wrong, because you spent the first 10 minutes going through all these definitions, complications. You should have started here on the brochure. This is good. I mean, I can get behind this. This sounds really good.
This should sign up for
5 to 6% guaranteed. I get life insurance for my family, and I can actually get access to the money. What could go wrong? This sounds perfect. I can see why this is what I'm finding on social media.
But now let's talk about the reality. In reality, only the cash value is growing at the dividend rate. So we're going to show you a case study in a moment where all that money that you're throwing into this whole life policy, not all of it's going to cash value. And so not all of it is getting the dividend rate applied to it. Even in the early years, you're not really building up very much cash value at all. So
right there, hear that? In the early years, you're not building up much cash value. Hence why we know their insider expert doesn't know how to design these. Let's keep seeing the reality, and I'll hit each point, and then we're actually going to just mathematically prove it. Craig, this is where we can really start to show some of that work you did on the back end.
Maybe it's not as great as just a savings account right now paying 5 to 6. There's one piece. The second piece is, if you want some of these bells and whistles like non-direct recognition loans where you can take a loan and still earn dividends, or if you want wash loans where you can make sure you never have a disparity between the rate you're paying and the rate you're receiving, it's going to cost more. They're going to lower the dividend rate that you receive on that. So
these are all the things that have asterisks on them.
These are all the asterisk things.
Okay, keep going.
How about this one? Fees and expenses can eat into your return. Nothing we've talked about right now actually covers the mortality expense fees or the commissions that are paid on these types of policies. That's a whole separate subject that we're not even broaching here. And then this one is a big one. Surrender fees typically don't go away until you've had the policy for at least 10 to 15 years. So what happens is you're signing this insurance contract saying, yes, I'm going to perpetrate this strategy. But if I change my mind and I decide I want to move away from this, if I want to get out of this at some point in the future, I'm going to be penalized from doing that. Well, all of a sudden that makes it sound like, well, maybe this isn't my money. You know, at the bank, if I don't like my bank, I can pull my money out and I can go choose a different bank. With the insurance policy, if I decide to pull my money out, I get penalized for not carrying in my part of the agreement.
I want to go back to something we covered a little earlier. If the Consumer Reports found the average rate of return is 1.5%, that has to mean that people aren't getting the 5 to 6%. Because we even went and pulled back when Consumer Reports came out with the article. Some of the dividend rates were actually up as high as 7%.
Yep.
So it's not like this is a different interest rate environment or things have changed a lot in that aspect. What I think is interesting when I started doing a little deeper dive on this, if you need your money in the first 3 years, that surrender fee is going to eat you alive, because
that's where we're going to pause. Now, this is where we get to school them all of you are already around the campfire, so most of you already know what we're about to show you. But this is where the rubber is going to meet the road. If it already hasn't, but this is really where it's going to happen. Surrender fees. For some reason, I have to believe these guys are confusing universal life, IULs, and VULs with whole life, because IULs, VULs, and universal life clearly has surrender charges right in the contract. The surrender charges are laid out. If you put money in, your surrender charge is this percentage in the first year, this in the second, third. Whole life does not have surrender charges. Whole life has cost of insurance, the mortality expense charge, okay, which is the cost of insurance, policy service fees, which I already hit, $50 or $100 per year. And then, yes, in the first year, there's a commission, which we're going to completely expose and show you. Okay, so the surrender charge that they're alluding to, I'm confused because nowhere in the whole life insurance contract does it ever say the word surrender charge. Am I wrong in saying that, Craig? Because I've read lots of them, including all mine.
Yeah, they say cash value, but it's not a surrender. So there's a number of, they talk about their spidey senses. My spidey senses have been going off that they just don't understand. And one thing I'd like to correct is they talk about in the brochure, and I'm not sure where they got this brochure, the guarantees of 5 to 6% dividends. What they need to separate out, there are guarantees in a contract. Dividends are not guaranteed. So I think it's a little disingenuous on how they presented that, because I would have to suspect that they know that there's a guaranteed part of the contract and a non-guaranteed. The non-guaranteed side is where the dividends come into play. And let me ask you, with all the insurance companies we work with, they've been in business for well over 100 years. How many times have they missed paying a dividend?
Never once.
Never once. So that's why we rely on them so heavily. But I think it's important to make sure that we're talking about the correct things in the contract. There's guarantees, which you already shared, anywhere from 2 to 3.25% or 3.75%. But then there's the non-guaranteed side, and that's what we're going to talk about. And they've already shared that their insider gave them a policy, has surrender charges, so we're not quite sure if it is a whole life. They've given us clues that there's no cash value or very little cash value for the first, 3 years? So, when you and I started talking about this, Chris, we're like, well, this doesn't sound like their insider knows how to design the policy.
Yeah, so why don't you pull up the stuff, and I'm just going to read to you a quote here real quick, and Craig will put it on the screen, and then I'm going to read you a disclaimer before we show the numbers. But Will Rogers does a quote. I say it all the time. So it is this. Okay, the biggest problem in America is not what people don't know. The biggest problem in America is what people think they know that just ain't so. I say this all the time, and that is such an important piece as we enter this last segment of this video and this analysis or debate, whatever you want to call it, because right here, you're seeing this firsthand. I mean, Will Rogers nailed it. The problem isn't what people don't know. It's what they think they know. These two gentlemen are trying to do a good thing, trying to educate people, getting their spidey senses out, but they're educating on information that they don't know what they don't know. And that's the sad part. And where they're getting the information is not a bad source. They're insider, but their insider doesn't understand the infinite banking concept and clearly doesn't understand, which you'll see in a moment, does not understand how to design a policy. So real quick, while we're doing that, this is a disclaimer. Any opinion expressed by me or my castmate Craig is solely our own individual opinion and not investment or personal financial advice. This content is for informational purposes only, and this information should not be relied upon for investment or other financial decisions. Nothing contained herein is financial, legal, or tax advice. I don't think I needed to read that for today, but just in case, so we're covering our bases, there you have it. Craig, let's put the rubber to the road right now.
So the first thing I think that we could jump into is let's talk a little bit about maybe the policy that their insider provided them. We don't have that. If they want to provide it, we could certainly analyze it. But we hear this often about how there's just not much cash value up front in some of these whole life policies. What you're looking at here, folks, is just a traditionally designed whole life policy where that full $10,000 that they're talking about, and you'll see later in the video, they used a 36-year-old individual in excellent health, putting in $10,000 a year, and they make the comment there's not much cash value up front. And the reason why is because when you put that full $10,000, into what we call the base portion of the contract. So there's really not any PUAs involved here. Look at the cash value for year one. Who wants to put $10,000 into their infinite banking system and have nothing to use or leverage in year one?
Not me, Craig. Not me.
What about year two?
No, I'm not really cool with that either.
What if you've put in $40,000 and I can get you access to $127 in 4 years?
No.
So if this is the way it worked, would you say they have some merit, or maybe even Dave Ramsey's got some merit in what he says?
Absolutely. So like if this is what the policies were that we designed for our clients to be used for the infinite banking concept, like by all means, like we've been pulling the wool over everybody's eyes. Like this would be a terrible place to put your money. And I say that all the time. Like a whole life, although good for the death benefit for your whole life, but if you're looking for early cash value or you're looking for a policy to access, like how many of you would agree? Like that wouldn't be what you'd want. You wouldn't want a policy that's no cash value year one, no cash value year two, $5,627 year three. When you put $30,000 in, I'm sorry, no, thank you.
Well, and I'll just share, I saw a comment scroll by. Janet had shared earlier that her daughter put a policy together and she's putting $400 a month to buy a car. And so if Janet's daughter had to wait for 10 years before she even had any cash value, well, she'd probably be in great shape because she's going to have to walk everywhere or ride her bike, but that's not what Janet's daughter's doing. So again, this is your traditional. Now there's another thing that comes up, and they talked about putting in $10,000 for, the 30 years.
Oh yeah. This is the part where we knew that their insider didn't know how to design them, because we don't even know how that would be possible unless it was loaded with term or unless this was what he designed. Craig, explain that.
Yeah. So for anyone that has an infinite banking policy, you'll typically see, if you're putting in $10,000 a year, something happens around year 10. And that's typically where we start dropping down into that base level. So let's just say, for example, you had a $10,000 annual premium, and we're splitting that into two pieces. So some of that's going into that paid up additions rider that creates that high early cash, not the high dividend, but the high early cash. And some of it goes to base because we have to meet the modified endowment contract rules. Let's just keep the math simple. We'll put 60% into PUA and 40% into the base. That means by year 11, we're typically putting in around $4,000 a year, maybe a little bit more, but that's typically the behavior we see. Is we can put 10,000 in for about the first 10 years, and then it drops down because we're under the gun of the modified endowment contract rules. So when Chris and I both heard that there's 10,000 going in for 30 years, we thought, well, either they're not doing an infinite banking policy, or maybe they have a 30-year term rider on, which creates a lot of cost into the policy. So we knew that their insider didn't develop an infinite banking policy like we do. So those are a couple of the spidey senses or the clues that we had initially to kick this off.
Let's show the audience and these two awesome gentlemen, let's show them what an IBC policy could potentially look like if it were designed properly. And then we can ask them and every one of you if this looks a little bit more appropriate for what you would want if you were designing a policy to be used for the IBC process, which they have alluded to really talk much about the process.
Yeah. So we'll jump back. This is your standard off-the-shelf whole life policy, 10,000 a year for the first 30 years, nothing going into PUAs. They did say, I think around year 30, they had 500 and some thousand of cash value. This has 466 with a death benefit of about $1 million.
So maybe they had a little bit going to paid up additions.
Yeah. So maybe they had some or different company, but we're in the ballpark. Now what we want to look at is a policy that is designed for infinite banking, where we're putting in that 10,000. And what I'm doing in this design is we're taking 75% of that 10,000 going into the paid up additions. Well, guess what happens? You immediately, within the first 30 days, have cash value to use for whatever it is, to buy your cars, do your investments. The first
Craig,
thing
another thing that's important, hold on, because they mentioned really high commissions in whole life, by doing this, by putting 75% of the premium deposit into the paid up additions, what you've effectively also done is reduced your commission, and I'm going to actually net it. You've reduced your commission by 73%. And that was because I netted out the 2% commission that is paid on the PUA. So, I mean, like that's, now if we were to do the math, and Craig, when you're going through this, I'm just going to, if it's okay with you, I'm just going to do the math on this and show people what that would be. So we're talking 10,000, but 7,500 of that in this example is going to PUAs, and then 2,500 is going to base. Am I correct in saying that?
That is correct.
Okay, so you go ahead and explain how we design this, and we'll just see from the audience if this is more like what they want. And I'm going to do the commission so we can debunk that the commissions are incredibly low on these versus the commission on that base policy you showed.
Right. So there's a few things you're going to notice in this policy design. We've got 10,000 going in for the first 7 years, and then it drops down to 9,892. The difference between these two, this policy design did require a term rider in order to support the modified endowment contract rules, which means you have to have a certain amount of death benefit for the money going in. So that's the first thing that happens is we drop down a little bit because we dropped our term insurance. We no longer need that. So now we're able to put in about $9,892. And we do that, we're just maxing this policy out. And about year 10 is where the most we can put in is about 2,500. Now, there may be some folks that say, well, you know what, this is not really what I'm after because I want to continue putting in $10,000 a year. The reason we design the policies this way is so we get that high early cash that you can use. And why most of us have multiple policies is you'll get to a point in the policy's life where you can't get in as much as you want. So we start additional policies. You know, we've all got multiples. So at this point, if you want to continue putting in 10, you might start up another policy so that you can continue doing the 2,500 here and maybe start up another policy because you have more income or more money running through your system. So that's one of the differences you'll see between their design and ours is that we're not able to put in the 10,000 because we're not going to artificially increase the costs by putting in a 30-year term. And we want to have that higher amount going to the paid up additions. So now as you look at the policy, going over time, death benefits increasing. We see a little bit of a drop because we dropped that term insurance. We had 291 to 213, but from that point forward, we continue to grow and grow and grow. So that's policy design number one. If there's any questions on this policy design, let me know, but I just wanted to draw out the biggest differences between what their insider provided for them and what we would typically do. So there are some pretty big differences here.
And Craig, I've got the math whenever you're ready for the commission.
Yeah. So do you want me to hit the dump in concept or
let's do that in a second. I just want to show them the difference in commissions because they keep saying high commission. And I just want to kind of get that out of the way. So we're talking about a $10,000 premium going into a policy. So we don't know this for sure that their insider did it this way, but let's just hypothetically say they were going to do 10,000 for 30 years. Essentially, really, it's 100% would be going to base. This is what Dave Ramsey's always talking about. Whole life's a high commission policy. So really, if it was a regular whole life, you're going to make about 55%. And that can vary a little bit depending on your production levels and that, but that's pretty much the standard. 55% of the premium paid into the policy. So if somebody put 10 grand into a regular whole life, the commission's $5,500. Now, I think all of you would agree that's a good day in the office. Let's come over to the design that we just showed you that we would do for the infinite banking. 75% goes to the paid up additions, which means we get paid a 2% commission on that $7,500. That's $150. Then 2,500 goes to the base, which was what the original whole life was, because you got to have some base for the MEC rules. So that's 55% of 2,500. That's $1,375. So our commission for that policy that you just saw would be $1,525. The commission on a regular whole life that Dave and maybe these two gentlemen's insider did would be $5,500. That's a $3,975 difference. Now, listen, I know all of you like us, or at least I hope you like us. And I'm thinking that everybody, loves their agent when they're buying a policy. But do you want your agent to get an extra $3,975 in commission and you don't get that 39.75, I mean, would you prefer it or do you want us to have it? You want it, right? Okay. So do you see the difference? So as we kind of do this, you're seeing like we're reducing our commission. So if you did the math, that's roughly probably about a 73% difference. And I'm not doing the math on that, but that's a significant drop in the commission. So Craig, show them what would happen if we dumped money in. Because remember earlier, these gentlemen said that, you know, you have to dump tons of money in. So let's show them dumping tons of money in.
One quick thing I want to add to that commission piece is, so this is your first year, right, Chris? So am I getting that 15.25 every year?
Oh, no, no, no. So what you would get, and I didn't do the math on that. So there is renewals on life insurance. I mean, it's great. Life insurance is one of the greatest businesses to be in, you know, but you're going to basically get, and it's going to vary a little bit. Let's just say out of this 15.25 for the next anywhere between 5 and 7 years, depending on your contract, that's the renewal period. You're going to get about 106.75 per year, give or take. And actually it would be a little bit less now that I think about it, but about that. That's about what you'd get each year in a renewal.
So I just want to rewind a little bit and go back to the comment about the high fees and commissions and compared to what. So if I'm in an indexed fund and I'm getting, you know, 1.5%, I'm getting that every year.
Oh yeah. Oh, 100%.
So
Man, I
when
used to, when I was an advisor for 16 years, we would charge 1.25. That was our rate, 1.25%. That's what we charged in a management fee. Now, we would invest our clients' money into mutual funds, ETFs, stocks, bonds, but those mutual funds still had another fee. So let's just say our fee for managing your investments were 1.25. And I'm sure these gentlemen, if they're managing money, it's probably between 0.75% to 1.25, maybe as much as 1.5, but whatever. So we would do that. We get paid that every year, whether your portfolio is up or down. But then the mutual fund that we invest in, I'm sure has some type of a fee, but let's say we did Vanguard, let's say it's 0.25%. So now you're 1.5% in, all in, every year. So let's just do that, Craig. Let's just say we did invest the difference. So I don't know, what was the difference, did he say, 788 bucks? So the difference would be $9,212 a year times 0.015, and again, could be different. So every single year, if you did buy term invest the difference, let me go to another screen, at 1.5%, and now 1.5% includes 1.25 to the advisor, that's their management fee, and I'm just doing 0.25 as a blended 12B1 fee and management fee for the mutual funds or ETFs, which that's really, really low, and I think all of you know that. So that's how we got the 1.5. You'd pay, let's just say everything's good, and we'll use the rule of 72. Your money at 10,000 at 7.2% doubles in 10 years, so it would double twice. So if you put in, I don't know, let's just do this. So if you put in 10 grand times 20 years, it's going to double twice. This isn't the way to do it, but I'm just doing this quick. Okay, times 2. So 800,000 bucks. And I think that's pretty close to what they said it would be at their 8% return that they somehow pulled out of the sky. I don't know, but times 1.5%. And I'm not doing this right, but that's 12,000 bucks. That's $12,000 on 800,000. And if it goes up, that's more. So,
and that's in a year, right?
Oh, that's just 1 year. In management fees, that's 1.5% of $800,000 in assets. And I did this over 20 years, right? I just assumed in 20 years, you put 10 grand in each year, your money doubled every 10 years because you earned 7.2%, which is the rule of 72. And but you would have been paying fees every year. The lowest fee you would have paid is in the first year, which would have been 138.18 at 1.5. But next year it's more because your money compounded, and next year it's more and more and more and more. So
yeah. So I mean the numbers are rough, but I love the exercise just because it's now magnified. Are these fees high compared to what you just went over? And I would say no, they're not high.
Real quick, Craig, let's just pause because we got so many people over in the chat asking, like, how do they contact us? Can you just put your link up there to schedule a call? Just in case people want us to review their policies, they want us to kind of talk to them a little bit more about that. I just hate that. I know this isn't the purpose of today, but I've literally seen it 5 times now. So we're going to just put a link over in the chat, folks. So if you want to book a call with us, just kind of review what you have, go over what we're talking about, just riff, then you can set up a call. There it is. All right. So Craig, where should we go? Do you want to go to the dump in one?
Yeah, let's talk about the dump in. Yeah, let's definitely talk about the dump in because that's another concept I don't think a lot of the experts understand, but Let me go ahead and share this out. So one of the things we like to do is we take the information out of the policies and put it into this cash value analysis. So this is still the 10,000 annual on a 75% PUA, 25% base. Now, one of the things we like to look at is the efficiency of when we put $1 into the policy or into the system, when do we get at least $1 of cash value growth? Remember how they talked about the surrender charges, you're not getting your money back for 10 to 15 years. In year 4, what I'm looking at is this cash on cash column. What we're measuring is when you put $1 into the infinite banking system product that we're showing here, when does it grow at least by $1? This can vary based on design. Sometimes it's earlier, sometimes it's later. But in this particular design where we're putting in $10,000 a year, at the end of year 4, we put in $10,000, but we grew $10,142. So here we are. We're now at an efficiency point where from this point forward, we're going to continue to get more back on a year-by-year basis than we put into this contract. So if we look down to year 10, we put in $2,500. The growth was $6,501. So for every dollar we put in, we got $2.60 back. I don't see where this surrender charge comes in for 10 to 15 years that they're talking about.
Craig, I'm just not seeing it myself. Anyone else seeing surrender charges here? I'm just not seeing it.
So Chris, would you be upset if you gave me $1 and I gave you back $2.60?
Yeah, can I negotiate that to $2.65?
Next year you could. Year 11, I'll give you $2.73.
That's right.
So-
Compounding over time. Yes, got it. I would not be upset.
So that's one of the things that's going on. Now let's take a look at a $50,000 dump in with that $10,000 annual premium. A lot of folks don't know about this concept where you can take a lump sum. Now, I'm sure these fellows at the money guys are going to say, well, here we are, we're talking about these big chunks of cash. Look, sometimes people are doing real estate or they have the money running through and they want to put it into the policy. So we can structure what's called a dump in where $50,000 is going into that paid up additions, and that creates high cash value to the tune of getting access to about 90% of this within the first 30 days. So you dump in 50,000, you'll have 45,000 ish available within the first 30 days to pull out. Now, you'll see in the cash on cash at the end of year 2, we've already got 105% cash on cash. So I'm putting $1 in, I'm getting $1.05 back in year 2, end of year 2. So again, where's this 10 to 15 years it takes me to get my money back? I got it back in year 2. And so this is just another example of a policy design that is an infinite banking design as opposed to what their insider provided to them. Chris, any comments or thoughts on this one?
No, I think that's probably good, just showing like how we design them versus how maybe their insiders designing them. But let's, we've got a few more minutes in their video. I'm going to speed it up a bit just to get through, because I don't want to show what they're missing and what Dave Ramsey's always missing, and that is the infinite banking concept, like which is what they said, like the infinite banking concept, the scam, the insurance companies are misleading you. Like we've got to get back to that, but all we've talked about is the product up to this point. But that's okay. Let's see what else these guys have to say. I'm going to speed it up a little bit, but I'm only going to go to 1.5, and we should be able to really follow along here.
A lot of the initial premiums is going towards commissions and other things. So there's going to be a steep surrender fee. So that's controlling your ability to vote with your feet on the front end. And then if you live to be a ripe old age, and the back end is going to get really crushed because the cash value is actually going to be paying the much higher cost of insurance. Am I reading this right?
Yeah, that's right.
So you don't really, this banking on yourself actually has a lot of asterisks and catches, is what I'm hearing. And by the way, if I can, for all the people who say putting your money in a 401k is putting your money in prison because you can't touch it, this is a better way. How do you get past the surrender fee?
You call this Alcatraz. If putting your money in a 401k is putting it in prison, putting in this feels like you're putting in Alcatraz.
Yeah,
This
doesn't tie to what I'm seeing out there.
And then this is what you just alluded to. This money is locked into a complicated insurance product. So all of us can kind of understand, if I have my money in a bank and I have it in a savings account, I need to go get it. I can go get that money and I can get statements on that and understand what's going on. Well, now we have this alternative to that that has a lot of asterisks, but maybe the numbers will be compelling. Maybe when we look at an actual policy that's actually been designed for this strategy, maybe then it's going to click. Maybe then we're going to say, aha. So let's look at a Money Guy case study where we actually test the numbers using a real policy designed by a real insurance agent. So let's assume that you have Infinite Banking Isaac. And Infinite Banking Isaac is going to put $10,000 per year into a high dividend, whole life paying policy in order to carry out infinite banking. That's what Isaac's going to do. And so the dividend rate we're going to assume, which is the dividend rate as of right now in 2023, is 5.2%. And the non-guaranteed values assume that this rate stays constant for the entire life of the policy. What we're saying is we're going to lock in 5.2%, and we're going to assume it does not go down even if interest rates fall. So we're trying to stack the deck in favor of the illustration. Make sense? All right. We're also going to say that by the time, since we're doing paid up additions, since we're buying more insurance, at age 65, the non-guaranteed cash value, this is from the illustration that an insurance agent actually provided for us, the non-guaranteed cash value will have grown to $532,000.
And you all remember, like the one that Craig did, like we were almost at the 531, maybe a bit shy. So you can see it's probably pretty close to just an off-the-shelf whole life.
The non-guaranteed death benefit at that time is $897,000 at age 65. Now, this is an important thing to mention. When Isaac first started buying this policy, remember the whole idea is I'm going to dump a bunch of cash in, I'm going to buy paid up additions throughout the life of the policy. When he first took the policy out at the very beginning at 36,
age 36,
it was only a death benefit of $196,000.
Okay.
So that $196,000 death benefit over the next 30 years grew to be $896, but it didn't start at $896 because I think that is something worth noting. His cash value by perpetrating the strategy went all the way up to $532,000. So the question is, what does his investment return look like?
Now, before you give us the aha moment, I want to make sure I put it out there. First of all, thank you to the life insurance agent that was willing to come forward and just share it with us. I mean, because it's hard to get information on these type of products. So to actually have somebody come and say, hey, I use these, I think I'd look.
Greg, I find it hard to believe that it's hard to find information about whole life policies from mutually owned dividend paying policies. So I don't know what he's talking about. It's so hard to find because it's everywhere. And what their insider did is nothing special. We've proved it.
Love to get your take on it and share it. We're not doing this just to straight up just rip it up. We tried to give it the best scenarios we could. I mean, let's face it, timing wise, interest rates are at the highs they've been in the last 30, 40 years. That's probably a great time to lock in guaranteed type returns. Sure. We tried to give it some benefits of the doubt on that. And we didn't pull any money out. So with all that and then thanking the insurance agent, what's the rest of the story?
So here's the rest of the story. Over this 30-year time horizon, if you look at the $300,000 that was paid into the policy and the guaranteed cash value of $532,000 and the guaranteed death benefit of $896,000, the actual rate of return that was received in this policy, 3.62% over this 30-year period. When you think about
that's a cumulative rate of return, assuming that money was never taken from the policy, the infinite banking concept, the process was never once used. You just put your money in a stupid regular whole life, let that money sit there and compound until whatever age he's talking about here. Not what we teach, not what the infinite banking concept is, but yet somehow this is what they're calling the infinite banking D-myth.
The return on capital that was deployed into this policy, 3.62%, does not get me super, super excited. And this assumes you didn't actually use it for the number one benefit that's touted from it, which is borrowing money from the policy through time.
And now, I know earlier you showed it on the assumptions page. This thing was paying over 5%. So for it to have returned 3.6, is that because it's back to what you said? You're only earning off the cash value, and then that's net of fees and all the other things that are coming through.
There are fees coming through. And
it's probably because there's hardly any money going to paid up additions, if any, in the policy. So the policy is anemic right from the get-go. You're off to a super slow start because you got no cash value in those first couple of years, the way that their insider designed it. And the policy was never used. You never took money out. You never made that money go to work a second time yet. All this talk about non-direct versus direct and all this stuff, like, why would you just leave the money in there? And I could keep going, but there is a cost of insurance to provide that death benefit. And in the cumulative return they're doing, that cost of insurance is as high as it can get because they're showing a cost of insurance on the full death benefit, where that's not how we do it, as you saw.
Then a portion of that every single year, every single month is paying for the insurance. So it's not like you had all $10,000 working for you or all $10,000 having that 5.2% dividend rate applied to it. Now, again, these are not numbers that we did. This is from an actual insurance policy. We just calculated the rate of return, 3.6% over the 30 years. So then the immediate question we have is, might there be a better alternative? Might there be something that looks different? If we were not going to do infinite banking what would the money guy team do? How would we approach this? Well, we said, all right, let's look at Manny the Mutant. And you guys have seen Manny the Mutant a few times on the show before. And let's assume that Manny wants the exact same protection as Isaac, but he's also going to just invest the remainder in the stock market, right? So Manny, a 36-year-old male in excellent health, goes out and gets $1 million 30-year term policy, right? And I say $1 million because we know at the end of Isaac's policy, it was worth about $896. We kind of rounded up. 30-year policy, $1 million of coverage. It's going to cost him $788 per year to have that term policy in place.
Now, right out of the gate, he's going to have a lot more life insurance protection
for the whole time
than the whole life. So he's, even though he's only paying $787 versus the whole life is paying $10,000, he's going to have almost 5 times the coverage.
That's exactly right. Instead of 196, he's going to start with $1 million. And then we're going to say, okay, well, we're going to have the same cash outflow as Isaac. So he's going to invest the remaining $9,212 into the market and earning 8%. We're just going to use an 8% rate of return for a 36-year-old investing for the next 30 years. How does this play out? Well, there would still have been a $300,000 capital outflow by Manny, but at an 8% rate of return on the dollars that were not buying the life insurance, right? That were not buying that, the $9,200 that was going into the market would be worth almost $1.2 million. And from 36 all the way to 65, because remember, it's a 30-year policy, there would still be a $1 million death benefit in place for Manny the Mutant. So when you look at these two stacked up next to each other, you have the infinite banking Isaac, who has $532,000 of capital available, but then you have Manny the Mutant, has $1.2 million of capital available.
Hold on. As Gold just said in the chat, how many of you think it's likely that over this long of a period of time, you're going to average 8% on your stock portfolio? How many of you can actually say that you've done that in the longest bull run in history? Have any of you averaged an 8% return? And they're assuming 8% every single year, folks, okay? So refer back to the videos we've done explaining what the average rate of return actually is. It's not what it seems. So again, just not good information being given here. And that's okay. We'll keep going, but just that they should put a disclaimer up to protect themselves, because that's probably not happening.
Isaac has almost $900,000 of life insurance coverage at the end of the policy. Manny had $1 million for the life of the policy. Isaac's money that he was investing, if you look at it, was making 3.6% in the single product he was investing in. Manny, the money that he was putting to work for himself, was making 8% over the long term.
Now, hold on one second. And this is so important here. So what if Isaac took his cash value, even in that anemic whole life, and then were to invest in this magic stock portfolio that earned 8%? Who would be better, the buy term invest the difference guy, or Manny, who took loans from his whole life, invested in the stock market at 8% and made money twice? Because I can show you, and we will in a bit, that Isaac would have made more than what he paid in the loan interest rate by a long shot. But anyway, again, that's not covered here. And I want to get through this, and then we're just going to go into our portion where we're going to school, or I'm going to say this nicely, teach them what they don't know yet.
We need to be completely transparent, though.
And we need to be completely transparent with them as well.
Age 66, the life insurance gone with this term.
It does.
The cost of insurance is going to be so expensive now because the underwriting is going to have to be done again. You would probably just not be able to afford the life insurance. So that $1 million will disappear.
Yep.
But I mean, it's one of those things when I saw this case study and I was looking, I was like, but that's okay, because realize, as we showed in the best case scenario for the infinite banking, the death benefit would be $896 and the cash value would be $532. You don't get to keep both.
No,
you only
it's
get either or. So the only way you get the $896 is if you die.
That's it.
Versus, at least with the investing, buy term, invest the difference, you at least now get to have the assets and then use the assets, and then your heirs get the assets later. You don't have to die to get the higher number.
No mention at all about what fees are being paid on those investments. So did they make a net 8%, or was that a gross 8%? If it was a net 8%, so that means they actually made like 9.5%. I don't know that anywhere during the period of time. Craig has a chart on this. The market has performed that over this long of a period of time, but maybe they never talked about taxes. So they're talking about liquidity. So now we can rule out the Roth. So the investments that they're talking about have to be taxed each year. So if you're making money in those investments and you're taking that money out and using it, as he just said, you got to pay capital gains or maybe even ordinary income tax. Not factored into this at all. Remember, the whole life, when you use the money, when you take loans, it's tax-free. So it's a huge difference. So we're talking about internal growth in the whole life being tax-free. We're talking about loans from the whole life being tax-free. So we're not giving any money back to the government in taxes, and we're not bleeding any money, except for the cost of insurance. Up at the top, they're just not painting an accurate picture, because they're not talking about fees on the investments, which the SEC clearly shows you what those are. They're not talking about taxes on any gains in those investments. And he did talk about the fact that when you die, if it's after that period of time when the term ends, you're technically self-insuring. So now, are you going to access your investments, or are you just going to leave them there because they're supposed to protect your family? Or are you just going to leave your family high and dry and be like, hey, kid, I taught you everything I know, pat them on the ass and say, hey, good luck. I'm spending all this money, which is what you should do. The money you save in your retirement, the money you save in your investment should be used to enjoy your life, not used to pass on to your family. That's what life insurance should be for.
Am I getting this
No,
right?
you're saying exactly right.
But I don't want this, because once again, it's coming off they don't put this in the TikTok videos, that's for sure. What are things we left out to try to make this as rosy of a scenario for this situation as possible?
Dare I say that what we've laid out here is the best case scenario. This is the best outcome, because here's what we did not talk about. This is the stuff we left out. Fees and commissions can be very high for whole life insurance. If you're buying low-cost index funds, the internal operating expenses are super, super low. We didn't even factor either of those pieces into the equation. We also assume that the non-guaranteed dividend rate at 100% of the current dividend scale today, right now with elevated interest rates. We know that the dividend rate right now is around 5.2%. Oh, in reality, over the next 30 years, it could drop. If we see
They could, and they could also go up. And a matter of fact, historically, we are at the lowest dividend. Well, we're 1 year off, or one dividend increase off the lowest dividend scales in over 30 years, because we've been in a historically low interest rate cycle. Now we're in a higher interest rate cycle, which we will stay here longer. Just listen to Jerome Powell. Higher rates for longer. We're going to be at this elevated interest rate environment for quite some time, or at least hypothetically for some time. And being that is, interest rates do not directly affect dividends. You see, insurance companies buy long-term treasuries, lock in interest rates. Therefore, they get a tailwind behind their money, hence why they can pay higher dividends for longer than interest rates. They're not cyclical like interest rates. So totally does not even understand what makes up the dividend payments, and doesn't understand that dividends are more likely to go up than they are to go down because of the cycle and the interest, or the environment we're in. Like, completely missed the boat on that. And I love that they talked about the fees and commissions, what they left out. They certainly left out fees and commissions on their investment assets, but he actually said that was something they left out because they were very low cost of index funds. You didn't factor any cost of the mutual funds or the investments.
interest rates come back down, there's a really good chance the dividend rate could also fall. We did not even factor that in. We also assumed, and this is probably the biggest assumption, there were no loans taken out. So the whole point of infinite banking, of banking on yourself, is that I can use myself as a bank instead of having to use the bank. Well, if you do that, all the numbers get smaller. They go down.
That is complete opposite of what the infinite banking concept is. They're saying that your numbers go down if you take loans. Why? Because of the cost of the loan. But that money that you took out from the loan is going to go to work. Let's say you pay off a credit card for 20%. Take the money from the credit card and put it back into the policy. How much did you make? Well, whatever interest rate you were given the credit card. Car loan, same thing. Investments, they talk about an 8% investment return. You take the money from the policy. You buy investments at 8%. Like, they're missing the boat completely.
They get lower. So if you actually use this strategy the way that it was designed to be used, it actually looks worse. It's going to hurt the illustration. And then we just assumed an 8% rate of return for investing. If you look over the last 30 years, if you would have just bought the S&P 500, the broad 500 largest companies in this country, it's annualized almost 11.3%.
This is kind of where, like, my spidey senses start really going off, Craig, and we're like, I can't hold it in anymore. And I know we're over time, folks, but we're having fun here. Hopefully you're all enjoying this. Craig, you have a really cool slide. So let's first show them the S&P 500 or some investments that, because I'd love to see 11.3% net of fees, net of taxes. Like, please do show me how that's even possible over the last 30 years. See, we do our homework, folks. We do our homework.
So I guess to be fair, they said the last 30 years the S&P was 8%. So since 1928, it's been 7.65%. And what I do is I look at on a year-by-year basis, what's the 30-year rolling average. So yeah, there are some times if we scroll all the way down here to say 1970, we had a 30-year average of 10.85, another one at 10.51. And then we had kind of a peak in 1975 of 11.16. But one of the things I wanted to do is find a period of time that's pretty close to the average. So here we are at 19, let's say 63. The 30-year rolling average is 7.75%. So let's take a look at what happens in our investment, because if we go to the actuals here, and basically what we're looking at here is starting in 1963, we're going to project out for the next 30 years. We already know it's about 7.75%. Let's just say you had $1 million and you're retiring in 1963. What I'm trying to figure out is what do we really have available to us? Because, the way they projected this was a linear, or, it's like a constant 8% growth, not factoring in drawdown effects, not factoring in sequences of returns when we have these losses. 3 weeks ago, Chris, you talked about retirement strategies. You talked about volatility buffers. You talked about a white paper. I don't know if anyone can see this on the screen, but this One America white paper on different retirement strategies. What I want to do is I want to refer to this document, and also I want to give proper credit. So let me just pop this up real quick, because on that document, it was written by Wade and Michael with a bunch of alphabet soup behind their names. These are smart folks. I don't have a PhD behind my name, but if I look at page 12, they start talking about, this is page 12 of that document. They talk about how much should we be taking out of our retirement accounts. So let's say that we have, $1 million. There's one strategy that says you can take a 4% drawdown, but this is calling out the fact that 4% is based on higher stock allocations than most retirees would be comfortable with. So what they do is they back down to this number of 2.85, which is more realistic for a retiree to do a drawdown on. So I'm just going to use these experts' numbers to say, hey, if you want to keep your money a 90% probability that you will not run out of money, do a 2.85% drawdown on your money in your stock accounts. So Chris, do you have anything to say about that? Does that sound reasonable?
No, I know when I was doing distribution plans, I always used 4%, but then we were actually forced by the company to reduce that down. And that was back then. So nowadays, 2.85 is the number.
Yep. So all I want to do is I want to say if I'm starting in 1963, because I want to just kind of replace some history, and we've got an average of 7.75. If I take out that 2.85%, it means I can live on about $28,500 a year. Is there a probability that I'm going to run out of money? Because as I'm going along, I've got an 18% return positive, a 12, a 9, then I go down the whole 13%. I have another 11 in the hole, a 17 in the hole, a 29 in the hole. But if I look at my end of year balances, what I'm looking for is, did I run out of money? And I didn't. Congratulations. You lived on $28,500 for the next 30 years. You didn't run out of money. But realistically, let's say that we're going to live on 70,000. I know that's a much higher allocation, but just kind of playing around with some numbers to see, even though we had a 7.75% return, I ran out of money in 1982. And the reason I ran out of money is when I have RMDs and when I have negative market conditions, 142,000 is my loss that year because of my withdrawal and the loss in the market that year. That hurt. So let me ask you a question. Chris, if you had one of these stupid whole life policies and you had cash value in it at retirement, what if you use that volatility buffer strategy and you put in, let's say it's even 50,000 instead of taking out the 50? So we're going to minimize the loss that we took that year. Well, I still run out of money, but I pushed it down a year. So what if every year I went where it was negative, the market was negative, and we just pulled money out of our stupid whole life policy?
Well, you'd have to have one of those stupid whole life policies to do this. Buy term invested difference would never work for this.
Too many zeros. So all I'm illustrating is we have another source of money that maybe when the market's down and we're pulling money out of our 401k, if I pull it from somewhere else because I've got one of these whole life policies, I just keep pushing that negative down into later years because I'm not having to take as much of a hit when the market's down. So these are just some things I wanted to share, just a kind of bouncing off of that strategy you shared maybe, I think it was 3 weeks ago, on the volatility buffers, the covered assets. So it's just another thing that comes into play when we're talking about infinite banking. But anyway, I like to just blow the cover off this whole 8% game because, one, you're not going to get an 8% return every year because there's taxes, there's fees. It's just unrealistic. And then even if you had close to that 8%, they're not factoring in the drawdown effects of what happens when you lose money in the market.
Yeah, and that's important, Craig. And I want to point this out because they're making it seem like, you're putting money in these investments and you're just going to be able to use this money because they're talking about liquidity, which is why we have the infinite banking concept in these specially designed whole lives, is to get the liquidity, to use the money during our life, not the way they're saying to use it, but to use it to make more money. And if you did that with an investment portfolio, buy term invest the difference, as they're saying, you would hurt the portfolio dramatically by taking withdrawals out to do the things you would do with the infinite banking concept. So I just don't know why they're using that scenario of, like the money's just going to sit there and grow. They always assume that you never touch the money. How likely is it that anyone that did buy term invest the difference is never going to touch that money in those investments? How likely is that? I'd say, I don't know the statistic, but I would say it's probably unlikely that they would never touch the money, which would blow those numbers up, especially if they took money from a negative year, as you just showed, Craig. So what is this drawdown effect?
This is showing what happens if we go back to the S&P 500. Let's just do a couple scrap captures here. So we have a -13, we have a -29, let's call it -30. So we have some big dips. So what this drawdown effect is really teaching us is when we have a loss, it's a 10% loss, how much do I have to gain to get back to zero? So if I have a 10% loss, I need to get 11% gain. We had a pretty close to 30% loss in one of those years in the S&P 500, but we need a 43% gain just to get back to zero. So this is a pretty wild ride of ups and downs. And I just don't think their numbers factored these types of losses and gains that are needed to recoup back to zero.
I agree, Craig. I don't think they're factoring any of these things in or considering any of these things, but they're trying to consider everything on the whole life side, but they're not considering anything on the investment side. Matter of fact, they said we assumed an 8% rate of return for investing. Over the last 30 years, the S&P 500 has annualized 11.3. Can you just go back to your S&P 500 thing? Go right up to 2023 when they did this chart. Just go, where's 2023 on S&P?
So I've got up to 2022.
We'll do 2022. So what was that? Oh, rolling. Well, what the rolling?
Well, so it's not going to roll forward because I don't have 30 years.
Yeah. But even just go the year before, 2021, the rolling forward 30-year was 1.71. So I don't know. Anyway, it's moot point. It doesn't matter. I mean, the returns are the returns, but you got to factor in fees. You got to factor in taxes since we're putting it in a non-qualified account, so that they have liquidity, as they said. We're not factoring any of that. So the returns are nowhere near what they're saying. And if you take the money out, you're not going to have what they're showing either. But with the whole life, you would have exactly what we're showing, because if you take the money out, you're not impacting the growth on the cash value because it's non-direct recognition companies paid uninterrupted compounding interest. So Craig, we just got a few more minutes in the video. Is there anything else on this portion that you want to hit?
I don't think so, but I just want to see real quick what this up until the positive. So, I mean, right there, just this short period of time at a 1.5% fee, we've got close to 200,000 of fees accumulated.
Wow, that's almost the majority of what you put into that whole life right there, just in fees.
Yeah.
And the other thing too, that they didn't really mention, but we show it in ours, like all those numbers we showed you on that policy illustration that Craig designed, that's net of fees. That's net of cost of insurance, net of mortality and expense charges, net of commissions, and net of policy service fees. Like that's net. We can't show it any other way. So
Chris, there's a couple other points. I mean, one, they talked about, when the interest rates are more than the gains, we could address that, or do you want to go over, an investing strategy with
well, let's
policy?
hit it, because that is a big thing a lot of people say. They say, well, what if the insurance company charges more on the loan interest than what you're earning in dividends and interest? So let's hit that.
So we oftentimes talk about, can you make money growing at 4% while taking a 6% loan? And I'm sure these guys would say, no way, you're going to lose 2%. So who in the audience thinks we can make money growing at 4% while taking a 6% loan? Anybody here think that we can actually get away with that? Drew says every day, yeah, but Drew knows the story here. So here's the exercise. Pull out a compound interest calculator and pull out a loan calculator. Type these numbers in if you don't believe our math is correct. But if we take a $25,000 loan balance at 4%, or we're going to grow our $25,000 at 4%, and we also want to take a $25,000 loan at 6%, and we're going to do this for 5 years, for 60 months. So what would the payment be on your loan? It'd be $483 a month. And so if we look at the future value of that, we're going to pay about $28,999. Let's just call it $29,000 for the sake of our exercise here. So our loan cost is going to be $29,000. Now, who thinks that my compounding over 5 years is going to be more than this $29,000? Anybody in the chat? Chris thinks there will be a higher number here. Well, I got to know. It's $30,525. So we made almost $1,500 by growing at 4% and taking a 6% loan. Now, were these guys just talking about what if your loan rate's higher than your dividend rate? Aren't you going to blow up your policy? When we look at the math, we're compounding on a lower number, but we're growing and growing. And on the loan, we're decreasing the balance over time. So the math works out, and we haven't really seen a case where we only grew at 4% and had 6% loans. I mean, I don't know of a period that we've had those conditions.
Never. As a matter of fact, I don't know a period where loan interest rates on the loans were higher than the dividends and interest paid on any of the companies we work with. Now, maybe companies like Northwestern, a great company, but they don't work for IBC because their loan interest rate's 8%, but we just don't use those companies. So Craig, just in the sake of time, I think they now understand the difference between simple and compounding interest. And hopefully these two gentlemen watch this and see that as well, because it's just mathematics. But let's just finish up their video real quick. And then I just want to kind of do the final thing where you show them the gains projector and show them like how infinite banking is supposed to work.
Over that 30-year period. So we kind of stacked the deck in favor of infinite banking and tried to be conservative on the man to the mutant side. And I still think it just doesn't make sense. I could not get there as to why this would be something that would be a strategy that I would want to carry out.
So it's complex. There's opportunity cost potentially with it, and all the guarantees have lots of disclosures and other
lots
things.
Of costs to the guarantees.
So here's my thing. Look, life insurance is a very valuable resource when you're doing financial planning. And I don't want people to watch this and think we're anti-insurance. We're not. I actually own quite a bit of insurance. I try to protect, I minimize risk as much as possible.
But all term.
It is all term. I just want to make sure though that people measure twice, cut once, because a lot of times, especially with financial products, read the fine print. There's a lot more going on beyond the brochure. And a lot of people, I mean, when you hear people who are trashing 401ks, which if you think about why are 401ks so successful is because it's not only your money that's working, a lot of times your employer is giving you absolutely free money to participate in this, to walk away from something that has got so many incentives and benefits and tax favored status. You have to go, man, there has to be a catch. And that's why I do appreciate, now look, I know there's probably gonna be people, I'd invite you, leave comments, tell us things that maybe we didn't think about, but I also once again want to thank that insurance agent for opening up his books, to kind of letting us see a best case scenario. I'll be curious to see what feedback he gives us after he watches this show, because he doesn't know the results of what we're going to do. But it is one of those things, I feel like there's so much information that we ought to just have covered this the way we did. And I hope that the Money Guy family, this was helpful for you guys. Bo, what other final words would you have on infinite banking?
Yeah, I just think that anytime you approach a financial product or a financial strategy, it should not be so complicated that you can't understand it. And if you can't understand it, ask someone else to explain it to you. And if they can't explain it to you, ask someone else. We tell our clients all the time, when we recommend a strategy, when we recommend a solution for you, we want you to be able to leave our office, go to the supermarket, and be able to explain what we explain to you to the person behind you in the supermarket. And if you can't do that, then we've not done a great job of explaining it to you. Don't feel like just because you don't understand something or just because something sounds complicated means it's good or it's right for your financial situation. Make sure that you are the general of your army of dollar bills, that your army of dollar bills needs you to be. Don't be sold by someone trying to spin your head and convince you that you need something you don't really need.
Yeah, I mean, this is one of those cases where buyer beware, do your research. I mean, the SEC.gov, all the government regulatory boards, they have lots of information on buying insurance, on buying your first investments. Guys, do your research. An educated consumer, Bo's already kind of shared this, is a better consumer. And that's one of the things we're trying to do is just give you enough information where you'll do a little bit more digging, a little more due diligence to figure out how do I walk this journey and build the best financial life for my family so that I don't have regrets, that I don't fall into traps, and I don't get myself in a moment where I look back and go,
And that is exactly what we're trying to do, is make sure you have the right information, the right path for your needs and goals. So now what I'd like to do, and this is going to be quick, folks. I know you've all stuck with this a lot longer than our normal webinar, but this was such an important video. We really needed to unpack the entire thing. So what we now want to do with Craig is going to show you, we do these tools for all of our clients, okay, the gains projector. We're going to show you the mathematics behind the process with using this specially designed whole life. Craig, you want to roll that part and show people how mathematically it is proven that the infinite banking concept works best with a specially designed whole life, contrary to what they said.
Yeah, so the last thing we want to do is put money into the policy and let it sit there. So to Chris's point, we have a tool called Gain Projector. What it does, it takes the policy, puts it into this tool. We can do some factors of what are your expected returns. Now, in this particular design, I just want to go down. I'm using a 12% return, and if these guys are watching the show, like, oh my gosh, we're using an 8% return, and they're roasting us on that. Why am I using 12%? The reason I'm using 12% is it's pretty common what I get. I get 12, 15, 18% consistently, because of what I do with the private money club, with the private lending. So first lien position, in control of the deal myself. So I'm the lender, regardless of the numbers, whether it's 10%, 12%, 15%, this is how things play out over time. So the first thing we're doing is we're just simply looking at the policy. This is just the policy without doing anything. I put the blue line as my premium, and the shaded area is actually the cash value growth. So we've already shown that you're going to put more in year one than you have access to use. You might even be putting in more in year 2 and 3 than you have to use. But in this particular policy design, by year 2, we have 105% cash on cash, meaning I put $1 in the policy, I can use $1.05. So by year 2, I've got more money to use than I put in the policy. And this is just what it looks like over time without even using the policy. Now, what we want to talk about is, this is a lot of data. It's a wall of numbers. I'm just going to go ahead and give you a quick glimpse of what's happening. Each of these columns is year over year. So at the end of year 1, what do things look like? At the end of year 2, what do things look like? So this is broken out into sections of how does your policy perform? And these fellas talk about, hey, if you take a loan, you're really getting a double whammy, because that interest charge, that evil interest charge. But what we're doing is we're spinning up a compounding machine, and you're going to see this over time here. So we've got 50,000 we dumped in. We have 10,000 that we put in premium, and we're taking almost 50,000 out in loans. And guess what we're going to do? We're going to put that to work. Now, this is generating a loan interest charge of about $2,400, $2,500. That's at 5%. And I can show you the math all day long that if we're paying loans back, if we're financing cars, I can have a 5% loan interest charge that might actually be 3%. It might be 2%. It might be 4.2%. So 5% is not always 5% because it's a simple interest loan. We'll cover that another day. But essentially what we're doing is we're putting this money to work into a private money club deal or private lending deal where I'm making 12% annualized and getting paid on a monthly basis. So what I'm doing down here at the bottom is I'm just simply showing you at the end of year 1, I've got almost $50,000 deployed in my investment. We made almost $6,000, $5,989 of gain. And out of that gain, I'm going to pay my loan interest. So I'm going to make a spread on this money. we can do the same thing with our home equity. We're just taking lazy cash out of the policy, and we're putting it to work. Now, what I'm going to do is I'm going to reinvest that gain and just keep compounding my gains. Here's the sad part about it. And Chris, a lot of people look at this and they'll go, wow, you lost 1.76%. Well, I put 60,000 into the system and I have 58,943 and almost $1 million of death benefit. But on a net, we're down from a cash perspective about 1.76% year one. My question is, are you okay with a little bit of loss up front or a little bit of, pulling the rubber band back to then look at year 2 at 5.8, year 3 at 13, 22? You're going to see something different than that S&P 500 chart I showed you, which was a roller coaster of ups and downs. This just continues to go up and up and up because we've got the compounding in the policy. We've got the money out working, making a gain, and it just keeps adding and compounding on each other. So year over year, we keep
think
getting
about that right there, Craig. I mean, just right in the numbers, the math. I mean, yes, you lose in the first 2 years, hypothetically, compared to if you did it their way. But after that, you're in the money because now you're making money twice on the same dollar because that's compounding interest. That's how it works. And we're factoring in the loan interest on every single factor here. So this includes all cost of insurance. This includes the commissions. This includes the policy service fee. And this also includes the loan interest rate paid back to the insurance companies. Those are the net numbers at the bottom. So like the thing is all day long, I'd be willing to give up for 2 days to make money for the rest of my life. And I know those two gentlemen would probably say, yeah, but you're using 12%. So we could run this at 8, 7, 6, 5. We could run this at any return you want. Obviously, what we teach is you always want your money working at a higher velocity than what the insurance or the cost of money is. So if the insurance company charges you 5, well, then send the money out to work at least 6. But, like we can run these numbers any which way. But I mean, come on, how many of you would give up for 2 years? And you're not even giving up. You're just paying for that insurance so that your family's protected. How much was the death benefit on this one, Craig?
Close to $1 million.
Almost $1 million if you die for the first 2 years. I mean, they like insurance. They're talking about terms. So yes, we're buying insurance in the first 2 years. We're paying the cost on the insurance because we don't have much compounding in those 2 years. But listen, 13, 22, 31, 40, 51, 63%. I mean, like those are the mathematics behind it. Like sign me up all day long to protect my family and then make that kind of compounding interest on my money. Like these guys, in their scenario, they're going to make 8 or 11 gross because they didn't net out the taxes or the fees, but that's okay. Here, like these returns trump everything they're doing. So again, it just comes back to what we were saying earlier. It's not this or that, it's this and that. They could just say, hey, we invest in these mutual funds or these ETFs or this portfolio. Great, tell us the blended return. We'll put it in and we'll show you what it looks like if you funded those investments by using this vehicle, the specially designed whole life, and the infinite banking concept. Because in these numbers, folks, is the process. This is what we teach. This is not just a product. This is a process that we're doing here.
Yep.
So anything else on this?
No, and we could go on for hours because we've got so many other things we could talk about that they're wrong on. I'd love to go into the loan interest costs, but
real quick, Craig, you could do that in like 2 minutes. Can we just show you one more thing? Yes, I know some of you have to go, but we just got to show you one more thing. And this is going to basically be like where they're talking about the loan interest rate as being such a big deal. But if you use the infinite banking concept and you're an honest banker and you repay the money that you earn out there back to the policy, paying down the loan, a 5% interest rate isn't just, you're not going to realize a 5% interest rate on the loans.
Yeah, and this really applies to if you're buying a car, you're taking cash value for your policy, buying a car. Nelson Nash always taught, be an honest banker. Whatever you are going to do to the bank, whatever you're going to do to the dealership, do to your own policy. So let's just say we took $10,000 out and we were not an honest banker. We didn't pay anything back. And Corey, you're exactly right. Don't steal the peas. So we didn't pay anything back for that year. We have a $10,000 loan at 5%. And what we're going to see is a $500 interest charge for that year. So yes, the math shows that that's a 5% loan interest rate. So we have $500 on our $10,000. But let me ask you this, what happens if we actually start paying the loan back and be an honest banker? And we start putting $500 a month into this policy. back into our
But for
policy.
those guys, let me quantify that. So if you were to do this, like you're not coming out of pocket $500. It's that loan that you took out, that 10 grand is out there earning more than 5%, because otherwise you wouldn't take the loan. You wouldn't take
Yep.
the loan and buy groceries or pay rent or pay utilities. You take the loan to go out and work at a higher velocity. So use their 8% number. So if you're out there earning 8% on the money, that 8% is what's paying the $500, and you got money left over to spare.
Yep, exactly. So really the mechanics of the loan, just think of it this way. When I put $500, because it is a simple interest loan, 100% of that $500 reduces my principal loan balance to $9,500. We have an interest charge on that, and we go into month 2. Now we're at $9,000. But one of the things I want to kind of show you is this red box. This is the interest charge if you're not paying the loan back. So you see that we're actually buying the loan interest down by being an honest banker and paying it down. So at the end of the year, instead of 500 of loan interest, it's 338. So your loan interest actually is, actually 3.38%. But the other thing that's happening that they don't understand is when I make that $500 loan payment back to the insurance company, that $500 goes back into my cash value that's available for me to use again if I need to or want to pull it out.
That's key. That is absolutely key. The payments you're putting back into the policy is money you have to use the next day. So you're not giving it up. You're getting it back. And you're reducing the interest that you're actually paying to the insurance company because you're reducing the loan. It's just simple mathematics.
Yep. So at the end of that year, I put $6,000 back into my pocket. I gave the insurance company $338. But if I'm making, let's say I'm making 8% on that, I not only have all this money back, but I also compounded and had a basically arbitrage between that loan interest cost and what I was making.
Absolutely.
So, I mean, that's just the math behind the scenes, and we can keep going through this, but when you're an honest banker, when you pay the system back, when you use the money for financing major purchases, when you use it for investing, it's always a win. It's not as these guys say, where if you use the money, now you're even further in the hole because it's a bigger ding. It just isn't. So a 5% interest is not always 5. And that's the message I'd like to leave for those fellows.
Yeah. And Craig, I want to thank you for all your time. I know you even have more than that, but just, I want to make sure we're considerate of time. We went way over on this, but that's okay. There's just a lot to unpack here, and we could even keep going, and there's more material. But, Craig, has built all these tools so that we don't have to rely on some, hocus pocus concept that, someone says works. We mathematically prove everything. And I'm hoping, and any of you that want to help us out, message the Money Guy Show, message them and tell them that they need to watch this video. Tell them that they need to learn from us and learn how this works, because I'm not saying that they're ever going to change their tune about buy term, invest the difference, but maybe this will shed some light on the fact that it's not the product, it's the process. The process is how you build wealth using this. The product just makes it work better because of that compounding interest. So I really, really hope this helped all of you. I hope that this helps the Money Guys, and helps them understand how the infinite banking concept works and how they then can have a different perception on how it works. And not only that, the mathematics, but also I hope that they realize that it's not about what they don't know. It's about what they think they know that's the problem. And they think they know all about this, where we just proved to you that they don't know what they don't know. But now all of you do, which is where it starts. So hopefully all of you, at this point have learned something today, and hopefully all of you are ready to kind of send them a message, or at least tell somebody else what you learned, because that's how this works. And that's how we spread the truth about the infinite banking concept, which I know our Nelson Nash would be very proud of that. And we will continue to do this. We will continue to change people's lives. We will continue to show people how to take back control of their money by being the bank. With that being said, folks, thank you all for joining us. If you're interested in booking a call, in the chat, I put Craig's link there. You can definitely set up a time. We'll go over your circumstance, review what you've got, and do that. And again, make sure you all go on to the Money Guy Show and tell them that they need to watch this, because that's the hope, that they bring us on and we can then educate them, maybe even educate their audience on how this works. But that's only if they're willing to learn something new, like all of you were. So thank you for joining us for this episode of the Wealth Webinar. We will see you this afternoon at Ask Me Anything, or we'll see you in Utah. Till then.
Thank you all.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.